Good evening, dear students. How are you all? All good? Good evening, good evening, good evening, everyone. So, I just welcome you back to our live session on CA Inter Paper 6A, which is Financial Management. And the ongoing topic is Financial Manage. In the topic of Financial Management is Ratio Analysis. So, we have covered the ratio analysis topic. I mean, the ratios are done. Now, it's time for us to look into certain questions. Right? We have done quite a few questions, but let's just take up some more questions in our today's discussion, right? Because I think that's the last session for ratio analysis today. So we'll be completing the ratio analysis topic today. So let us take up certain questions. I think we have completed certain questions. Question, I think second was the one that we did, and third is also done. Now let us go ahead with this question number 4, guys. Let's look at this question 4. Let me just paste it into our answer sheet. So today I'll be solving in pen paper mode, not using much of the Excel, because I just want you guys to get a idea of how are we supposed to represent the things. Okay, so from the following information, you have to prepare a summarized balance sheet. Now, when we have questions which are talking about preparing, summarized balance sheet, what are we really supposed to do? How do we approach that question? How do we, kickstart that question? So the first step is to prepare the format of that summarized balance sheet, because it will actually help you to have an understanding what all things we need to calculate. So first we have fixed assets. Of course, we do have fixed assets in our balance sheet because there's a ratio called as fixed asset to proprietary ratio. So fixed asset is definitely going to be there. Working capital is surely going to be there. So you'll have like current assets. Okay, in that current assets, we are definitely going to have liquid ratio and current ratio. These are the two terms given. So liquid and current ratio gets bifurcated, or they get distributed only on the basis of the stock. So in current assets, I will have stock or inventory, and you can say other current assets. Okay. Then proprietary ratio, you will definitely have the share capital and reserves also. Okay, share capital, reserves, and then we have the current liabilities. Current liabilities. So in current liabilities, you are going to have bank overdraft and other current liabilities. Now, of course, from this, we can see the bank overdraft is 40,000. That's already given to us. Of course, the total needs to be calculated with regards to the current liabilities. Then we have the reserves and surplus, which is 1,60,000. Now we don't know what is the share capital. We don't know what is the fixed assets. We don't know the inventory, current assets, right? Either current liability, or even total current liabilities is not known to us. So you have to fill up these values. So let's just kickstart this with the available information. And to start with, always look for, to start with this, we should be always looking for like working capital. Like we have a working capital number, and connected with the working capital, which is the ratio that we can use? Obviously, it's the current ratio. So let's use these two terms. So we have the working capital available with us. Working capital is basically current asset minus current liabilities, right? So this current asset minus current liability is 2,40,000. Okay. And then current ratio is 2.5. Current ratio is 2.5. And this current ratio is obtained as current asset upon current liabilities. And therefore, current asset will be 2.5 times of current liabilities. Current asset is 2.5 times of current liabilities. So we have got these two equations, right, guys? Can you solve these two things and give me the value of current asset and current liabilities? Solving equation 1 and 2, can you provide me, I mean, you can solve it and give me the value of current asset and current liabilities? Can you do it? Yeah. Can you calculate the current asset and current liabilities, guys? You can, right? So let's just try to calculate this. Give me the value of current asset and current liabilities, guys. Solve it and give me the value of current asset, current liabilities. You just need to substitute the current asset in the first equation. Yeah, guys. Okay, so you say current asset, I mean, we'll say substitute 2 in 1. So substituting this, we'll say 2.5 current liability minus current liability is 2,40,000. So this is 1.5 current liability is 2,40,000, and then current liability is going to be how much? 2.5 divided by, 2,40,000 divided by 1.4. That's 1,60,000, right? So we got the current liability as 1,60,000. And then we'll say substitute current liability of 1,60,000 in, let's say, first equation. So current asset minus 1,60,000 is 2,40,000. So current asset is 4 lakh. So you've got the current asset value to be 4 lakh. Right. So current asset is arrived at. So we have the current asset value to be 4 lakh and total current liability value to be 1 lakh 60,000. Now it's quite obvious. What will be the value of other current liability, guys? What will be the value of other current liability? Of course, it's going to be 1 lakh 20,000, which will include all your creditors and outstanding expenses and everything. Okay. So that is done. Then let's take up the next one. So we have 240 and bank OD, it is done. Then we have the liquid ratio of 1.5. Now the liquid ratio of 1.5. Liquid ratio of 1.5. This is arrived as liquid ratio is current asset minus stock upon current liability. So current asset minus stock upon current liability. So this is 1.5 is equal to current asset of 4 lakh minus stock is something, inventory which we are not aware of. So stock upon current liability of 1 lakh 60,000. So when you solve this, what is the stock or inventory that you're getting? What's the value of stock or inventory that you're getting, guys? What's the inventory? Value of inventory, guys? 1 lakh 60. Yeah. So we got the value of inventory in our question to be 1 lakh 60,000. So of course, other current assets will amount to 2 lakh 40,000. Got it? Now, so we have used current ratio, we have used liquid ratio, bank overdraft, working, everything is used. Now only one ratio is left to be used, which is fixed assets to proprietary ratio. Now here we don't know two things, the share capital as well as the fixed assets. So how do we go about solving this now? So we have like fixed assets to proprietary ratio given to us 0.75. So we'll say fixed asset to proprietary funds. So fixed asset to proprietary funds is 0.75. So we have fixed asset not known to us. Even proprietary funds, we don't know what is share capital. So we'll say share capital plus the reserves of 1 lakh for 60. This is 0.75. So fixed asset is 0.75 share capital plus 1 lakh 20,000. This is the value of fixed asset, right? Now, how do I obtain this thing? Because we don't know what is the share capital and what is the fixed asset. Both the things are something which is unknown. So we'll talk of total assets. So total assets. Total assets will be fixed asset plus current asset. So fixed asset is 0.75 share capital plus 1 lakh 20,000 plus current assets of 4 lakh. This is 0.75 share capital plus 5 lakh 20,000. Then we have total liabilities. So total liabilities is going to be share capital plus reserves plus current liabilities. So share capital is something that we are not aware, but the reserves is 1,60,000 plus the current liability is also 1,60,000. So this becomes share capital plus 3,20,000. Now, of course, this is equation 3, this is equation 4. Can I say, as per the fundamental balance sheet equation, total assets should be equal to total liabilities. So total assets is 0.75 share capital plus 5,20,000 is equal to share capital plus 3,20,000. So we can solve this and give me the value of share capital, guys. Give me the value of share capital. Yeah. What's the share capital, guys? So you bring all the share capital on one side. So you have like 320 and so coming this side, you can say 520 coming this side and getting subtracted. So we have 2 lakh, 2 lakh, and this going on the other side, that's 0.25. So 2 lakh. So share capital is how much, guys? 8 lakh, right? So the share capital is 8 lakh, right? So 8 lakh plus 3 lakh 20, so 11 lakh 20. 8 lakhs. Yeah. So that's share capital is 8 lakh. So we got the share capital value to be 8 lakh. And now we can get the fixed asset value also, because fixed asset was anyways, we'll say since fixed asset is 0.75 share capital plus 1,20,000. So that's going to be 0.75 into share capital of 8 lakh plus 1,20,000. So 0.75 of 8 lakh will be 6 lakh plus 1,20,000. So fixed asset is 7,20,000. Okay, so total is 11,20,000. So balance sheet tallies at 11,20,000, right, guys? Are we done? Are you able to get this, everyone? So balance sheet tallies at 11,20,000. Correct, guys? Okay, fine. So balance sheet tallies at 11 lakh 20,000, guys. Perfect. So that's question number 4. Now, on similar lines, we'll have the next question, which is question 5. Not exactly similar, but yeah, you can think of like the approach needs to be on the similar lines. So we have the information regards to current ratio, liquid ratio, working capital, stock turnover ratio, average debt collection, fixed assets to shareholders' net worth, reserves and surplus to capital, gross profit ratio, and we have to drop the balance sheet. So would you like to give it a try first, guys? Yes, Adil. What is your doubt in share capital? What's your doubt, Adil? Hmm? You can unmute and ask. No? Okay. Anyways, question 5, guys. Would you like to give it a try first, guys? Like I'll set a timer and just try to solve it in rough. Okay, so Adil is asking how 8 lakh came. Well, this 8 lakh is simply 5 lakh 20 coming over here as subtraction. So this will be like 2 lakh. And this coming up over here. So 0.25 share capital is 2 lakh. So share capital will be 2 lakh divided by 0.25, which is 8 lakh. Got it? Yeah. Working capital includes bank overdraft, but not does not include short-term bank borrowing. Short-term bank borrowings will be also included in this. Your current liability will include short-term current liability. So short-term bank loans also. Okay. So question number 5, would you like to try first? I'll give you time to roughly solve it. Maybe approximately 5 minutes just to solve it quickly, and then we can start with the solution. Works for you, everyone? Yeah. Just 5 minutes. Just try to roughly solve the answer. I mean, prepare the balance sheet, and then we can look at the detailed solution. Okay. So here we go. Let's start, guys. Okay, so let us look at the solution for this now. So we have the current ratio, guys. Current ratio is 2.5 and liquid ratio is 1.5. We have the net working capital, right? Uh, so when we have like net working capital is 3 lakh and you have current ratio and liquid ratio available for us. Okay, one second. Aste Singh, book is excludes the short-term bank borrowing in net working capital formula. Short-term bank borrowing, no. If it is short-term borrowing, if it is like payable, whatever is payable within a year, that will be your current liability. Okay, so that has to be a part of your current liability whenever it is payable within a year. If the payment is going to happen beyond a year, then you will say it is uh, not a part of current liability. Okay. Okay. Anyway, so current ratio is 2.5, liquid ratio is 1.5, and net working capital is 3 lakh. So we have the current ratio given to us. So current ratio is current asset upon current liability, which is 2.5. So we'll say current asset is 2.5 times of current liability. Okay. Then we have the working capital given to us. So working capital is current asset minus current liability of 3 lakh. So current asset minus current liability of 3 lakh. So this is our equation number 1. This is equation number 2. So we'll just say substitute 1 in 2. Therefore, current asset minus current liability is 3 lakh. Therefore, current asset is 2.5 current liability minus current liability is 3 lakh. So we get the current liability as 3 lakh divided by 1.5. So current liability is going to be how much, guys? How much is current liability? 2 lakh. And once we have the information of current liability, we can also think of current asset. So which is basically, therefore, current asset is 2.5 times of current liability. So current asset is 2.5 times of current liability, which is 2.5 into 2 lakh. So we say current asset is 5 lakh. Okay. So we got the current asset to be 5 lakh. Current liability was 2 lakh. So current liability 2 lakh. Current assets of 5 lakh. Right. So current liability 2 lakh. Current asset of 5 lakh. Now we will use the liquid ratio to arrive at the stock figure. Liquid ratio. Liquid ratio is current asset minus stock upon current liability, and this liquid ratio is 1.5. So current asset is 5 lakh minus stock is something that we need to compute upon the current liability of 2 lakh. So this is 1.5. Therefore, the value of stock is going to be equal to 1.5 times of 2 lakh, which is 3 lakh minus 5 lakh. So stock is 2 lakh, guys. Okay, so we got the stock value. Okay, so we have current ratio 2.5. This is done. Networking is done. Now let us go for using the stock turnover. Now stock turnover is clearly specified that it is cost of sales upon closing stock. So stock turnover is cost of sales upon closing stock. So we can get the stock for cost of sales from that. So we have stock turnover. stock turnover. This is going to be cost of sales upon stock. Cost of sales upon stock. Okay. And this stock turnover figure, which is cost of sales upon stock, that is given to be 6. So cost of sales is something that we need to compute. Cost of sales upon stock is 2 lakh. So cost of sales is 12 lakh. So cost of sales is 12 lakh, right? Now, once we have the cost of sales, the best connected part for this to calculate other part is a GP ratio, right? So gross profit ratio is given to us. So gross profit ratio is what? 20%. Now this is arrived as gross profit upon sales into 100. So 20 is, we don't know what is the gross profit, but we definitely know the cost of sales, right? So we can say, in fact, when we say gross profit ratio is 20%, we can say that cost of sales ratio is how much? Cost of sales ratio is 80%, right? So, and this cost of sales ratio will be sorry, cost of sales upon sales. So 80 is equal to 12 lakh upon sales into 100. So what is the sales value then, guys? Sales value will be 12 lakh divided by 80%, which is 15 lakh. Right? So sales is, 15 lakh. Then from sales, we are going to get the value of debtors, which is representing the average debt collection period. So we'll say debtors collection period is given to us to be 2 months. Right? Debtors collection period is 2 months. Now we arrive this debtors collection period by taking debtors upon credit sales into 12. So 2 will be equal to debtors upon credit sales. So this is going to 2 equal to debtors upon. Now entire sale we can assume it with to be based on credit, because there's no information about how much proportion of sales is based on credit. So we'll say this is 15 lakh into 12. And therefore, the value of debtors is going to be equal to 15 lakh into 2 by 12. So 15 lakh into 2 by 12, debtors is amounting to how much, guys? 15 lakh into 2 by 12, 30 divided by 12. So 30 lakh divided by 12. 15 lakh into 2 by 12, which is 2 lakh 50. Yeah. So debtors is amounting to 2 lakh 50,000, guys. Debtors is 2 lakh 50. Okay. So we have fixed asset, reserves and surplus to capital ratio is given, and then GP ratio is given. Okay. So let's try to prepare the balance sheet. So we'll have fixed asset, current assets, share capital, reserves, current liabilities. Okay, so we know the total of current assets and current liabilities. So current liabilities is total is 2 lakh. I don't think there is anything about the current liability. So current liability will be just one figure. So current liability is 2 lakh. Current asset is 5 lakh. This is 2 lakh. And total of current assets is 5 lakh. Now out of this current assets, we know the value of stock. We know the value of debtors. So stock is 2 lakh. Debtors is 2 lakh 50. And of course, this is your other current assets, which is 50,000 balancing figure. Now we don't know what is fixed asset. We don't know share capital and reserves. So we just have the ratios available with us, which is fixed assets is 0.8, right? And reserves and surplus to capital is 0.5. Okay. So we'll say fixed asset to share capital plus reserves. This is the ratio given to us. Fixed asset to share capital plus reserves is given as 0.8. So this is 0.8, right? And fixed asset will be 0.8 times of share capital plus reserves. So we have fixed asset. Let me name this share capital plus reserves as X. So 0.8X, right? So we'll say fixed asset is 0.8X. And the total of this is going to be X, right? So we'll just add them together. So this is what 2 lakh plus X. And this is 5 lakh plus 0.8X. Right, so 2 lakh plus X. And on this side, we have 5 lakh plus 0.8X because fixed asset is 0.8 times of share capital. Right? So let's just equate both of them. So we'll say assets is equal to liability. So assets is going to be 5 lakh plus 0.8X is equal to 2 lakh plus X. So let us bring numbers and variables on one side. So we'll thus have 3 lakh is equal to 0.2X. So the value of X is 6 lakh. So we say that share capital plus reserves is 6 lakh. And we can split this into two parts, which is reserves and capital surplus to capital is 0.5. So share capital plus 0.5 times of share capital is 6 lakh. Because they say that reserves is 0.5 times of share capital. Right? Reserves and surplus to capital is 0.5. The reserves and surplus to capital. So if your capital is 1, then the share capital is 0.5. So this is 1.5 times of share capital is 6 lakh. So what is share capital, guys? 6 lakh divided by 1.5. 6 lakh divided by 1.5. This is 4 lakh, right? There's a mistake. X is 15 lakh. Yeah, this is 15 lakh, correct. So if this is 15 lakhs, what will be the share capital, guys? 15 lakh divided by 1.5. Share capital is what? 10 lakh. And of course, the reserve is going to be half times of share capital, which is 10 lakh into 0.5, which is 5 lakh. So reserves is 5 lakh. Share capital is 10 and reserves is 5 lakh. So we get the values over here. Share capital is 10 lakh. Reserves is 5 lakh. Adding them together, it is 15 lakh. Right. So balance sheet tallies at maybe 17 lakh. And on this side, we have 0.8 times of 15 lakh. So 0.8 into 15 lakh, that is 12 lakh. So your fixed asset is 12 lakh. So 12 plus 5, that's again coming out to be 17 lakh in total, guys. So the balance sheet tallies at 17 lakh. Got it, guys? Okay. So when just gross profit is given, can we assume that it is on sales only? It is on sales only, obviously, because all GP ratios and P&L ratios are based on sales. Okay. Shall we go for next one? Yes. Would you like to solve the next one also on the similar lines? And then we'll discuss the solution. Make sense for you guys? Yeah. Would you like to solve this first, guys? And then I'll give the solution to it. Yeah. Saipa is asking if are the liquid ratio, absolute liquid ratio different? Yes. In absolute liquid ratio, you only include cash and cash equivalents. Whereas in liquid ratio, you include the debtors also, basically. Okay. So here's the question. And can like, I'm giving you, let's say, 7 minutes for this to solve. Come on, guys. Let's try to solve it quickly. Okay, so can we make an exam balance sheet in T format? Yes, you can prepare the balance sheet in T format because we are preparing this balance sheet for analysis purpose. I mean, and it's not on the basis of Schedule 3 as such. From the following particulars, you're required to prepare the balance sheet of zinc company. Fixed assets after writing of 30% is given as 10 lakh 50. Let me prepare the balance sheet and try to get the values over here. Okay, so fixed asset is 10 lakh 50,000. This will remain as it is. The fixed asset is going to remain, will remain as 10 lakh 50,000 only, right? So we have the fixed asset value, 10 lakh 50,000, right? Which is, uh, of course, after 30% depreciation, so that will remain as it is because there's no balance sheet where you write the gross figure. You only write the net figure, which is the fixed asset of 10 lakh 50,000. Then what all do we need is we will have the finished goods in our books, finished goods, and also the stock of turnover. So under after fixed assets, we'll have the current assets also. Current assets, you will have raw material, finished goods, right? Then we have the debtors, raw material, finished goods, debtors. Then, of course, we'll have other current assets. Then coming to the liability side, we'll definitely have the current liability, but in that, I don't think there's any other aspect, so it's not there. So we'll have the current liability as one single figure, maybe. Then we have reserve to capital ratio. So we'll have share capital. And then we have the reserves. Okay, share capital reserves. Then we are definitely going to have Okay. And we'll have the debentures also because there's a debenture available. So we have the debenture, and debenture interest is basically 7%. So debenture also needs to be captured. So now since we have the fixed assets available, we'll first take into account the fixed asset turnover, which is on cost of sales. So let us get the cost of sales. Okay. Uh, so fixed asset turnover ratio is cost of sales upon fixed asset. And cost of sales upon fixed asset is given to be 2. Since we have the fixed asset as 10 lakh 50,000, cost of sales upon 10 lakh 50,000 is equal to 2. So cost of sales will be 21 lakh. Cost of sales is 21 lakh. And then GP ratio on sales is 25%, right? So GP ratio is 25%. Therefore, cost of sales ratio will be 75%. The cost of sales ratio is 75%. So can I say 21 lakh is essentially sales into 75%. So we get the sales figure as 21 lakh divided by 75%. So sales is going to be 28 lakhs. Right? So sales is 28 lakh, guys. And once we have got the sales, we can now think of getting the value of finished goods, right? So finished goods turnover on cost of sales is 6. So let's try to get the finished goods value side by side. Finished goods turnover ratio is 6. Finished goods turnover is 6. And therefore, cost of sales upon finished goods is 6. So cost of sales is 21 lakhs. So 21 lakh divided by finished goods is 6. And therefore, finished goods is 3 lakh 50,000. So we got the value of finished goods as 3 lakh 50,000. Right. So finished goods is 3 lakh 50,000, right? Then GP on sales, net profit before interest to sales is 8%. And then we have fixed charges cover ratio. So we'll have to first get net profit before interest or EBIT as a percentage of sales. So EBIT is going to be 8% of sales. So 8% of 28 lakh. Which is 2,24,000. And then we have fixed charges cover is 8. Fixed charges cover is 8. And now this 8 is going to be EBIT upon interest. So which is 8 is equal to 2,24,000 upon interest. So what will be the amount of interest, guys? Interest will be 2,24,000 divided by 8. Right? 2,24,000 divided by 8. So how much is this? 28,000 is the interest. The amount of interest is 28,000. So since the interest is 28,000, what will be the debenture? Debenture will be interest of 28,000 divided by rate is 7%. So how much is the debenture amount, guys? 4 lakh. So debenture is 4 lakh, right? So fixed charges cover ratio is taken care of. Debt collection period is something that we have to use now. Debt collection period is 1.5. So debtors collection is 1.5 months. We know this comes out to be what? Debtors upon sales into 12. So 1.5 is debtors upon sales. What is the sales value? 28 lakhs into 12. So what will be the value of debtors, guys? 28 lakh into 1.5 divided by 12. Debtors is 3 lakh 50,000. We got the debtors as 3 lakh 50,000. Then next is material consumed to sales is 30%. So we can get the material consumption. Is 30%, right? Material consumption to sales is 30%. So that's going to be 30% of sale value. 30% of sale is 28 lakh. So 30% of 28 lakh, which is 8 lakh 40,000. Material consumption is 8 lakh 40,000. Material consumption is 8 lakh 40. Now what is the stock? Stock of material is 3 months. So stock of material is 3 months, right? So it's going to be 3 months by 12 months. 3 by 12 into 8 lakh 40,000. So 3 by 12 into 8 lakh 40. 8 lakh 40,000 into 3 by 12. 3 by 12 into 8 lakh 40,000, which is 2 lakh 10,000. Stock of material is going to be 2 lakh 10,000. Okay, this is also done. Then we have the current ratio, quick ratio, and reserves to capital ratio. So now, of course, there's no information about other current ratio. We can just say this is what the total current assets is. So what's the total current assets going to be, guys? Total of current assets is 7 plus 2 plus, 7 lakh. So that's 9 lakh 10,000. Right, guys? Current assets is 9 lakh 10,000. Do we have any other way to calculate the current asset total and the quick asset? Because there's no information about any other aspect. Rather, current ratio is 2.4 times, guys. And quick ratio is 1. Okay. So how do we go about calculating that part? Because it's just 9 lakh 10,000 of current assets is given. So we can get the current liability in from that because there's no other way out. We can think of the current liability or any other current assets for that case. Okay. So we have the current ratio given to us. Current ratio is 2.5, which is 2.4, sorry. 2.4, which is current asset upon current liabilities. So that's like 9 lakh 10,000 divided by current liability. So therefore, current liability will be 9 lakh 10,000 divided by 2.4. This is what somewhat some absurd answer we are getting. I don't know. Current liability. Or are we losing out on something? Like, is the raw material correct? Raw material stock is, stock of material consumed to sales is 30%. So material consumption is 8 lakh 40, and then that is going to be stock of material is 3 by 12. So it's going to be in terms of months consumption, so 3 by 12. That's correct. Then we have the current ratio, quick ratio. Well, we can't be assuming that part, total current thing, because we can actually think of two variables over here. We'll think of two variables. So other current assets, let's take it as X, current liability, take it as Y, right? So when it comes to current ratio, it's going to be current asset upon current liability. Quick ratio is going to be current asset minus the stock upon current liability. So this is 2.4 and this is 1. So current asset is 9,10,000 plus X. 9,10,000 plus X upon current liability of Y is 2.4. And quick ratio, it's going to be, apart from the stock, what we have is, removing this one, it's just 3,50,000 plus X. So this is 3,50,000 plus X upon current liability is 1. Now, of course, we can solve this simultaneously and get the value of X and Y, guys, because if you're taking that as a current asset only, that we would have taken that if there's no other information given. But since we have this set of information, we can definitely get the value of X and Y. So this is 9,10,000 plus X is equal to 2.4Y. And then we have 3,50,000 plus X is equal to Y. Okay, so let's bring all Y terms on one side. So it's 2.4Y minus 9,10,000 and X is Y minus 3,50,000. So it is 2.4Y minus 9,10,000 is equal to Y minus 3,50,000. So therefore we have 1.4Y is equal to 9,10,000 minus 350. 9,10,000 minus 3,50,000, which is 5,60,000. So we get the Y value as 5,60,000 divided by 1.4, which is 4 lakh. So Y is 4 lakh. So Y was basically the current liability, right? So we have the current liability as 4 lakh. And therefore, current asset will be 2.4 times of 4 lakh. So 2.4 times of 4 lakh, that's 9,60,000, right? So we can definitely say that this side we have current liability of 4 lakh. Total current asset is 9,60,000. So since this is 9,60,000, other current asset will be 50,000. Then the share capital and the reserves. Coming to the share capital and reserves, we have the ratio of reserve to capital of 0.21. So reserve to capital, it is 0.21. We know the balance sheet should tally at what? 20,10,000, right? So balance sheet should tally at 20,10,000. 20,10,000. So we know the total of these two should be 12,10,000, right? Now, if it is 12,10,000, quite obvious the reserves to capital is 0.21, right? So reserves is 21,000 and share capital, sorry, reserves is 2,10,000. And this is 10 lakh. Okay. Right. So this is the balance sheet that we are able to form out of it. Are you all getting this balance sheet, everyone? Okay. Everyone? Okay, guys. So with that, we are done with this question number 7. Okay. And now let's just take a stock we did not include in current assets. I think we were talking of earlier. Okay. Okay, so let's just take a break right now, guys. Break of around 15 minutes, and then we'll come back and do a couple of more questions followed by the MCQs. Okay, let's take a break, guys. get started. Let's begin, guys. Let's take up the next question. Okay. So we have this question wherein we are supposed to prepare the P&L as well as the balance sheet. Now, let me just do it in a bit different way. I'll prepare the format of balance sheet and P&L for you, and you're supposed to fill up the values. Okay. So let me just give you the format. Profit and loss statement. This is like, we'll start with, you should know what is the sales. Then we subtract the COGS to arrive at gross profit. Right, and then from that, we will have to compute the net profit also. Long-term loan is there. Debt collection periods, all sales are on credit. Fixed asset, capital reserve. Okay, so less other expenses, which will give you net profit. This is the statement format for P&L. Same way, the format for balance sheet. This will have fixed assets. Then we'll have the current assets. In the current assets, we will be subtracting, we'll have the raw material, finished goods, debtors, raw material, finished goods, debtors, and other current assets. Then on this side, we have the capital, reserves, then long-term loan. Capital, reserves, long-term loan. And then where we have we'll have current liabilities. Okay, so this is the balance sheet and P&L format, guys. Would you like to try to fill it up? Yeah. In fixed assets, the fixed charges coverage in previous question, repayment will be included if it is given. Otherwise, we ignore. Yes, Asta, you are correct. The notes are not uploaded for chapter 1. And this sheet also we will get for solving. Yes, I'll be sharing this once the session, the lecture is done. So once the chapter is done, then I'll be sharing these questions. And also first chapter is pending, I know. That also I'll be sharing with you. Don't worry. Okay. So just try to fill up these values, guys, from the given information. Try to fill this. Yes, Aditi, not getting. Don't worry, I'll solve it. We'll be solving it, don't worry. Okay, let's proceed. Okay, so following information and financial ratios of PQR relate to the year end 31st December 2006. So you have the GP 15% of sales. So do we have the number of GP over here? No. So all these are percentages, months, and everything is given, right? But the only thing which is given as a number is the fixed asset of 26 lakhs. So let me just write down the value of fixed asset at 26 lakh. And I have to derive all other values using this fixed asset value. All other values will be derived using this fixed asset value of 26 lakh days. Okay. So fixed asset of 26 lakh. So fixed asset to sales is 1.1 is to 3. Fixed asset to current assets is given, right? And we with this we'll be able to calculate a lot of things. So first let us use the fixed asset to sales figure. Fixed assets to sales. Fixed asset to sales is 1 is to 3. And so we know fixed asset upon sales is 1 by 3. Fixed asset is 26 lakh. So 26 lakh divided by sales is 1 by 3. So we can say sales is 26 lakh into 3, which is 78 lakhs. So sales is 78 lakhs. Okay. 78 lakh is the sales value. So we got the sales value of 78 lakh. Now, we have the gross profit ratio as 15%. So definitely we can get the gross profit ratio. Gross profit ratio is 15% of sales. So of course, from this we can get the value of gross profit. So gross profit will be 15% of 78 lakh. So gross profit is what? So 11 lakh 70,000. So gross profit is 11 lakh 70,000. Of course, what will be the COGS then, guys? Cost of goods sold will be the difference between them. What's the COGS number? What is the COGS? 66 lakh 30,000. So COGS is 66 lakh 30,000. Then other expenses. For that, we need to look at the net profit number. You can definitely calculate the net profit. Net profit is 8% of sales. So this is 8 by 100 of sales value, which is 78 lakh. So 8 by 100 into 78 lakh. What will be the net profit figure? 6 lakh 24,000. So net profit is 6 lakh 24,000. What about the other expense? Other expense will be the balancing figure, which is the difference between gross profit and net profit. Five lakh 46,000. So in this way, we are able to complete the P&L. Right? 5 lakh 46. The P&L is done. Let's go to the balance sheets, I guess. Now, fixed asset to sales was used. fixed asset to current assets is 13:11. So it's quite obvious we can get the value of the current assets because we have fixed asset to current asset. Fixed asset to current assets. This is 13:11. So we have the fixed asset as 26 lakh upon current assets. So we get the current assets to be equal to 22 lakhs, right? The current assets is 22 lakhs. Then raw material, finished goods, debtors, and other current liabilities we have to compute. So let's first use the current ratio, guys. So current ratio is 2:1. So obviously current liability, we can arrive at. So since current ratio is 2:1, which means it is going to be 2 upon 1 is going to be 22 lakhs upon current liability. So that will give us the current liability value. Current liability is how much? 11 lakhs. Right, guys? Current liability is 11 lakhs. So current liability is 11 lakhs. Then long-term loan to current liability is 2:1. So we have long-term debt to current liability. Long-term liability to current liability. Long-term loan to current liability is 2:1. Now we know the current liability has 11 lakh. So what will be long-term debt? Long-term debt upon 11 lakh is 2. So long-term debt is 22 lakh. Right? Long-term debt is 22 lakhs. Okay, long-term loan to current liability is used. Then the capital to reserves and surplus is to be calculated. Capital to reserves and surplus. Of course, we can say the balance sheet tallies at what amount? Balance sheet tallies at 48 lakhs. Right? So balance sheet tallies at 48 lakh. So of course, the total of capital and reserves is going to be 48 minus 33. 48 lakh minus 33 lakh, which is 15 lakh. So capital to reserves is 15 lakh. Capital and reserves is 15 lakh, but the ratio is 1:4. So we have like capital plus reserves is 15 lakh. Capital plus reserves is 15 lakh. And also the question says that capital to reserves and surplus is 1:4. Capital upon reserves is 1/4. So therefore capital will be equal to reserves by 4. Or we can also say that reserves is 4 times of capital. So we'll say this as capital plus 4 times of capital is 15 lakh. This will give us a capital value. So capital value is what? 15 lakh divided by 5, which is going to be 3 lakh. Right? So 3 lakh is the capital value. And but obvious the balancing figure 12 lakh is the reserve. So balance sheet has tallied, but are we complete with the solution? Or do we have yet to calculate something? You have to calculate some more numbers. Yeah. Which are the numbers that will compute? The raw material stock, finished goods stock, debtors, and other current assets. So for that, we have the numbers as stock of raw material, which is 3 months usage, stock of finished goods, 6% of the works cost, debtors. So you have to use that. So first up, for stock of raw material, we need the raw material consumed. Right? So raw material consumed is something that we'll have to compute first. raw material consumed. So what is the raw material consumed, guys? Raw material consumption is 20% of works cost. This is going to be 20% of works cost. Obviously, we are going to say, what is this works cost, sir? We can definitely take here to be COGS. So 20 upon 100 into, what's the COGS number? We have the GPS 11 lakh 70. So out of 78 lakh, 11 lakh 70 is 78 lakh minus 11 lakh 70,000. So 78 lakh minus 11 lakh 70. And 78 lakhs minus 11 lakh 70,000. On that, we are going to take it as 20%, which is 13 lakh 26,000. This is the raw material consumption. And what will be the stock of raw material, guys? Stock of raw material will be 13 lakh 26,000 into how many months or days they are talking of? It is 3 months usage. 3 months usage. So into 3 by 12. So 13 lakh 26,000 into 3 divided by 12. That's 3 lakh 31,500. Right? This is the stock of raw material we've got. So the stock of raw material is 3 lakh 31,500. What about finished goods? Finished goods, they're saying it is 6% of works cost. So that's very simple. We got the stock of finished goods as stock of finished goods is 6% of works cost. Okay, so that's going to be 6 upon 100 into works cost is essentially your COGS. So it is 6 upon 100 into COGS is we got the COGS right over here. Yeah, anyways, it's going to be 78 lakhs minus 11 lakh 70. Okay, guys, what's the stock of finished goods? 6% of this, right? So 78 lakh minus 11 lakh 70,000. On that, you have 6%. So 3 lakh 97,800. So this provides us the stock of finished goods. Stock of finished goods is 3 lakh 97,800. 3 lakh 97,800. That's the value of finished goods. Value of finished goods. Then coming to debtors. Debtors is given the question to be 60 days. Debt collection period is 60 days. Now the question has not specified any assumption to be taken for number of days. We can definitely take 65 days. So debtors is going to be equal to debt collection period. Sorry, debtors is all sales are on credit. So 60 days. So it's going to be sales into 60 by 365. So what is the value of sales? Sales is 78 lakhs into 60 by 365. So what's the value of debtors, guys? Value of debtors, guys? 60 divided by 365. So 12 lakh. 12,82,192. So debtors is 12,82,192. So of course we are left out with the balancing figure, other current asset, or maybe the cash and bank balance. So how much is the other current assets, guys? What is the value of other current assets? Give me the value of other current assets. Value of other current assets, guys. Other current assets is 1,88,508. Okay, 1,88,508. Right. So this completes this particular question. Okay. Now let's take a very conceptual question now. Okay, try out this one. Let's look at this question. Not this. Hmm. Suppose you take an assumption that the current ratio is 2. There are 5 transactions given to you. Just think and tell me whether the current ratio will increase or is it going to decrease because of these transactions. Assuming the current ratio to be 2, which one of these is going to have an impact? Let's have a look at it. First up, when you are going to make a payment of current liability, when you're going to make a payment of current liability, what's going to happen to the current ratio? What's going to happen to the current ratio is, if you pay the current liability, what will happen to the current ratio? So let's just take an example. All current ratio is 2. So let's say current ratio, it was, let's say, 2000 upon 1000. Now suppose you're going to make payment of any current liability. So let's say out of 2000, you paid, let's say, 500. So obviously your current asset will decrease and even current liability is going to decrease. So this is now 1500 upon 500. So of course it is 3, right? So it is increasing. So in the first case, we'll say that the current ratio is going to increase. Second is purchase of fixed asset by cash. If you're going to purchase the fixed assets by cash, what's going to happen to the current ratio? Because when you're purchasing fixed asset, the cash balance reduces and a fixed asset comes in. So your current asset reduces. So this is going to be reducing. Third one, cash collected from customers. Will the current ratio remain same, or is it going to say increase or decrease? Third one, if you're collecting cash from your customers, no change is happening in the current assets. I mean the current ratio, because you collected from the customer. So there's a reduction in the debtors and there's an increase in the cash balance. So there's no change. Fourth one, bill receivable dishonored. So you had a bill receivable which you got dishonored. What will be the effect? So if the bill receivable is dishonored, the bill receivable balance reduces, but the debtor balance will increase. So of course, there's no change. Right? Bill receivable is dishonored. So bill receivable decreases and the debtor balance increases. What about the fifth one? Issue of new shares. When you're discussing of issue of new shares are issued. So of course, cash balance is coming in. So current ratio increases, right? Because current assets is increasing. Are we good, everyone? Yeah. Okay. So now let me just uh, put in front of you certain MCQ questions. Yes. Now. Yeah, yeah. No, no, I'm just putting the screen on share. Wait. Okay, so we can start with the questions. Look at the first one, guys. What will be the first answer? What is the first answer, guys? How much time do we say to solve ratio analysis question? Well, timing is dependent on the now and the mark of the question, guys. Like if the question is for ideally you should be like 1 mark should be you should be able to solve it within 1.5 minute, right? So if it's a 5 mark question, you should be roughly be solving it within 8 to 9 minutes. So current ratio is 2.5, quick ratio is 1.5, current liability is 4 lakh. What's the amount of inventory, guys? So amount of inventory is 3,20,000, or is it 4 lakh? So total current assets will be 2.5 times of uh, current liabilities, which is 2.45 times of 4 lakh, which is 10 lakh, right? And then the quick assets is going to be 1.5. So quick assets will be 1.5 times of current liability. That is also going to be like 6 lakh. And inventory is obviously going to be current assets minus the quick assets, which is 10 lakh minus 6 lakh is 4 lakh. So of course option is C, guys. Okay, fine. Option is C, which is 4 lakh. Then what about the second question? 21%. So option C, 21% is the answer, right? Because you have the EBIT, from that you subtract the interest, and that becomes PBT, and further you're going to subtract the tax. So that should give you 21% as the answer. Now, what about this? A company has a net profit margin of 8%, asset turnover ratio is 2.5, and equity multiplier is 1.8. So what is the return on equity as per the DuPont model? As per the DuPont model, what will be the return on equity? Because it's simply going to be like net profit margin of 8% multiplied by 2.5 times of turnover. and 1.8 being the equity multiplier, right? So it should be what? 8% into 2.5 into 1.8. So that's 36%, guys, right? So option C is the accurate one. Fourth one, inventory turnover and closing stock question. What about this fourth one? Fourth question, guys, try it out. Opening inventory is 1,20,000, purchases is 6,30,000, sales is 8,40,000, and gross profit margin is 25%. Right. So over here the answer is going to be 90,000, guys. Yes. Right. Inventory turnover is 6 times. So we can get the cost of goods sold first. So cost of goods sold will be 8,40,000 into 75%. That's 6,30,000. And this divided by 6 will give you the average inventory. So average inventory is 1,05,000. This means if your opening inventory is 1,20,000 and average is 1,05,000, so obviously closing has to be the 90,000 figure. Okay, done, guys. Then what's this fifth question? Proprietor fund is 12 lakh. Proprietor ratio, which is proprietor fund to total assets, is 0.6. Right. So we can get the total assets as 12 lakh divided by 0.6. Total assets is 20 lakh. So we can get the fixed asset value, which is simply 20 lakh minus the working capital is 3 lakh. So 17 lakh. So option D, 17 lakh will be the answer. Okay. Fine. So with that, we are through the chapter of ratio analysis, guys. Yes, Nagaraj, you have any query?
Yes, sir.
Yeah, Nagaraj.
Sir, previous question,
Which one?
which one minute,
The
sir.
MCQ or the full solved?
MCQ.
MCQ, okay.
MCQ, no, not sir, not MCQ.
Mm-hmm.
Um,
This question.
one minute, sir. Sir, assuming the 17th question, sir. Assuming the current
Okay.
ratio. So
This,
that question fourth is fourth bill receivable dishonored.
mm-hmm.
So decline because of
So bills receivable, if it is,
bill receivable is a current asset. So a customer is a fails to pay. So bill receivable removed from current assets.
yes, but when the bill receivable is removed from your current assets, simultaneously there will be a debit to the debtors also in your books.
Yes, declined. So
Decline, so debtor will again come, right? Because when you have received the bill, you would have credited debtors and debited bills receivable.
because of debtors, if you still expect payment or a bad debts, I don't know.
No, you're not writing it off. You're not writing it off as bad debts, right? You're not writing it off as bad debts. It's still there in our books as an amount receivable. The bill receivable is just dishonored. The debtor has not gone bankrupt.
The customer fails to pay.
The customer is failing to honor the bill. The customer is not saying that he is defaulting or he has gone bankrupt. So you can still recover from him. Okay. So I think
Okay.
you need to brush up the bills discounting concept again. Because there, when the bill receivable is dishonored, you will credit the bills receivable but debit the debtor. Basically, your bills receivable goes out and again the debtor comes in.
But it has no liability, liability discounted to bill.
Where is the liability here? How come debtors are your liability?
Dishonor,
Huh? So dishonored, so how come you will have a liability?
a discounted bill.
So bill discounted. Bill, no, it's not discounted. It's a bill receivable dishonored. It's not a discounted thing. Where did you say that bill discounted is dishonored? It was just a bill receivable which you had in your books and that got dishonored.
Oh,
Okay.
okay.
Yeah. Yes, Asta.
Sir, in quick assets, it is written that in seller's market, inventories are also near cash assets.
Hmm.
Sir, what is seller's market?
Seller's market is when the seller is having the power to decide or to sell. So, like basically, you have limited sellers, but there are a lot of buyers. So, you are sitting on certain items which are quick to sell, which you can sell it easily. So, you can definitely say those sellers can also take stock in their quick assets because you're selling such items which can be quickly sold in the market, right? So, there are buyers who are ready for it.
Okay. Okay, sir.
Okay.
Sir, can you please check the page number 3.8 net working capital? Sir,
Which one?
formula given is wrong there then.
Page number
Sir, net formula 3.8.
3.8. Net working capital.
Yes, sir.
So net working capital is current asset minus current liability, excluding the short-term bank borrowing. Yeah. So when you say net working capital, you will exclude the short-term bank borrowing. And again, this short-term bank borrowing will be something, generally if it is repayable after a year. So if it is within a year, this is definitely going to be subtracted. Like if you have borrowed for, let's say, 2 years. So
Okay.
obviously repayment is not immediate. You're going to repay after 2 years. So that is not going to be, going to be a part of our current liability.
Sir, but in question, if it is not written about the timing, then we have to assume
You
anything.
assume it as short term. I mean, short term means within a year.
Okay, then we will deduct it.
Yeah.
Okay, sir. Thank
Okay.
you, sir.
Yeah. So with that, let's just stop here for the day, guys. See you Saturday with one more chapter. to begin with. Bye bye, guys. Good night. Take care. Yeah. Thank you.